Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I'm delighted to have Mark Bayley, Portfolio Manager at Kapstream, back in the studio. Welcome, Mark.
Hi, good to be back, Liz.
Thanks so much for joining us. We really appreciate your time. I know the US election was last week, but I'm keen to hear your thoughts on the outcome. And, there's been a lot of press about what Trump policies will do. Do you have any thoughts?
I always got thoughts, Liz. You know me. I guess the election probably went as the market expected. So that there hasn't been a huge reaction, mainly on the bond side. And the reaction that was probably expected would have been to see a bear steepener. So that's kind of the US government curve kind of going higher, but going higher at the long end. But actually, we've actually seen a bear flattener. So that's been the belly of the curve, and also kind of the 2 to 3 year curve, part of the curve underperforming a bit, and the 10 years and longer actually performing better. So that's probably been counts to what most people would have expected to see. And that is probably largely due to the fact that I think Trump was largely expected to win, and probably most of that had been priced in. Now, that's not to say it won't kind of continue along that path of a bear steepener in due course, but at the moment, that's kind of the initial reaction that's come through. In terms of what we see as positives for the market in terms of that Trump election victory, obviously tax cuts and tariffs are potentially on the horizon as and when he gets into office, and the sectors that benefit are the ones that everyone's talking about, kind of energy, the drill baby drill policy, defense, private prisons. And you've seen, crypto is obviously up significantly in the last few days, I think hitting record highs again. So those are the kind of the few sectors, and the expectations of the market have been largely correct in terms of what he's planning to do, or seems to be planning to do at the moment.
So, there's been a bit of contention about the path of the US rates now. Do you still forecast cuts this year and into next year?
Yeah, as we all know, the Fed cut last week, 25 basis points into that target band of 4.5% to 4.75%. Will it cut again in December? Probably, and that's certainly what the market is telling us in terms of the chance of a cut in December. I think that's pricing in around about 65 to 70% chance of a cut. And if you look at market pricing, we're still expecting to see another 3 cuts by the end of next year, 2 to 3 cuts by the end of next year. Obviously, it depends on inflation. What Trump does, and potentially does he squeeze out Powell, or does Powell manage to hang on as well? So I think it's certainly going to be interesting. I think the trend is definitely for more cuts to come through if inflation behaves itself, and all indications are that it does. That said, in the US kind of government bond space, we're not necessarily negative on those, but there is potential for kind of downside surprises, and for higher rates coming through if inflation doesn't behave itself. And generally in our portfolios, we're kind of currently running interest rate risk, interest rate duration at around about 1 year. Within that, probably the US is at 0.3 years, and Canada at 0.3 as well, Europe at 0.3, a bit in New Zealand, 0.1. And we're actually marginally negative in Australia in terms of our positioning there. So we've gone generally to those countries where we see a fairly defined trend for central banks to be cutting, economies slowing, inflation kind of under control, and where we expect central banks to continue to cut going forward. And that's not just in the US, but in those other countries as well.
So I'm keen to just talk a little bit more about different types of bonds and the markets you see for them at the moment. Can we talk a little bit about corporate bonds in the US and Australia, other markets? What's your approach to them at the moment? I know spreads have been tightening.
They have, and so if you're looking at the broad US corporate bond spread, which is kind of stripping out the risk-free, however you want to define that. If you're looking at purely the corporate credit spread, in the US. Looking at that index there, that is very, very close to being all-time tights. It's probably in the fifth decile for spreads being on the tight side. Now, if you move towards a shorter dated part of the US credit spectrum, kind of say from 0 to 3 years, then the credit spreads there are actually close to average. They're probably in the 30th to 40th decile for tightness in spread. If you move that to Australia and you look at the Australian credit market there, credit spreads there are probably in the 40 to 45% decile for compression. And so the Australian market at the moment is a lot more attractive in our view to the US market, and therefore our portfolio of bonds is definitely skewed more heavily to exposure in Aussie dollars across the various different sectors, and less in the US because we see that as less attractive for our investors.
Obviously, with that very low duration, you have a preference for floating rate securities, and does that include things like asset-backed securities?
It does. Yeah, we have a decent portion in securitized. The factor there to consider, and one that we focus on, is that we know that we are a liquidity provider to our investors. A couple of our funds are daily liquid, and so we're very cognizant that we don't want to have that structured portion of our book getting too large. So that's because we know that in times of stress, the structured part of the market can freeze up in terms of liquidity, and liquidity isn't as strong. In terms of our focus between floating rate and fixed, we're actually agnostic between the two. And the reason for that is if we buy a fixed rate bond, we just hedge the interest rate exposure out. So again, we're just capturing that credit spread part of the return profile. So, in terms of the fixed and floating, as I say, we're agnostic. We'll look at which one offers better value to the investors, after we've stripped out the interest rate component of that return.
So I just want to move on to private credit. I know that's something that you've been looking at, and it's been in the press a lot lately. There's been concerns about transparency and fees. And do you want to talk a little bit about your view on private credit, and is it starting to look a little bit shaky abroad and here as well?
Yes, yeah. I mean, private credit. First up, it's a very, very broad asset class. There's probably three main types. There's the leveraged corporate loan market. There's direct investment in real estate, and then there's what we focus on at Kapstream, which is the warehouse space. We've seen various articles either in the FT talking about corporates that are preferring to use PIKs, which is payment in kind type loans, and that can be a bad sign. That can be because corporates don't have sufficient cash flow to pay out actual coupons, and so what happens there? The coupons accrue to provide the investors income down the line. Now, there is good reasons why companies may want to use PIK loans or PIK bonds. Maybe they've got a growth strategy, but generally, I think in this environment, they're trying to preserve their cash flow, and that's generally because they're struggling or they're kind of heading into signs of stress. And more broadly in that credit environment, we're seeing defaults increasing, especially in certain sectors, construction and housing, and also the distressed ratio is increasing. That's the number of bonds trading below 80 cents in a dollar that S&P follows. That we're seeing that increasing. So you're right there in terms of the corporate loan side of things. We think that is becoming a bit more challenging environment. So that we do remain cautious on a leverage loan side of that private credit spectrum. In terms of real estate, that's been pretty well documented in terms of Australia and abroad, especially down the commercial channel, office space. There's still issues there in terms of how that working from home does play out in the long run, and we see various revaluations of asset prices in that space. And again, that's one that we are cautious of and haven't invested in. So, as I say, we focus on the Australian warehouse sector, which is basically the pre-public securitized market. So, of that structured space that we were talking about that we have in our portfolios, this is the structure, the trusts that hold those various assets before it gets distributed into the broader public market. And those originators that use those facilities, they use our funds along with senior banks to on-lend to their customers, whether that's a mortgage or for asset purchases such as a car or on personal loans. And, we started with a blank sheet of paper probably about 4 years ago, looking at various different opportunities in the private credit space. And we decided that we felt that the warehouse sector was one that was closest to Kapstream's DNA, which is, the heart of it is the capital preservation angle that's important to our investors. And so that was the part that we focus on. We like that opportunity in the warehouse space because typically they're short-term facilities. That means your mark-to-market is significantly lower. We like the fact that they're bespoke terms and you can negotiate those on a multilateral basis, but you still have control over the actual documentation and on what you can actively achieve in those negotiations is significantly different to what you can achieve in, say, a corporate loan or a real estate transaction where sometimes it's take it or leave it. These are the docs and these are the terms. We also have the ability to end after that 1 year in terms of becoming a declining financier in the facilities. We also feel there's probably less competition in this sector, in the niche space of warehouses, especially in Australia. And also the fact that a lot of these portfolios, so we've got several warehouses on our books at the moment. The underlying portfolio of assets is probably around about 40 or 50,000 loans. So like anything, loans go bad for various reasons, but if you're in a corporate loan or if you're in a real estate loan, your concentration risk to those bad loans is significantly higher than to an individual in that 40 to 50,000, very, very broad, diversified pool of the underlying loans that are typically in the warehouses. Now, we do invest in the mezzanine tranche of that warehouse. So above us is typically the senior banks that provide the bulk of the financing at a lower cost because they're senior. We're in the middle, in the mezzanine tranche where we find the risk versus reward to be most attractive. And then also the bottom is the originator, which has got the equity underneath us. And they always have skin in the game in the warehouses that we invest in. So they're very heavily invested in making sure that the loans that they write not only adhere to the credit policy, but they're also very good loans because they take that first loss if loans start to go bad and there's losses coming through into the books. That they will be potentially the first one to take that write down. So that's kind of the broad space that we're in. We've been doing this for nearly 4 years. We've probably invested over 800 million across that portfolio time frame, and probably at the moment we're close to 250 million in terms of assets actually invested in warehouses because they kind of grow, get termed out, and then kind of get redrawn again. So we personally think that's a really attractive asset class for investors. Obviously not particularly liquid, so it's only a small part of those portfolios. But since January, we've actually started and launched a new private credit fund available to wholesale investors. And the liquidity on that is quarterly. And again, we're trying to make sure investors know that the liquidity on those types of transactions aren't, particularly liquid, but equally you're getting that liquidity premium of maybe 150 to 300 basis points more than you would do in the public markets. And there's a reason for that, and the reason is illiquidity for capturing that additional premium.
So a couple of things struck me there. What does that sort of relate to as in all-in yield at the moment? Is that 7-8%, something like that?
So all-in yield is actually a bit higher than that. So we're targeting on that private credit fund cash plus 6, and we're probably running it close to cash plus 7. So that's the RBA rate plus 7. So you're looking at kind of 10.5%, 11.5% type area. So double digits, very healthily. And as I say, we feel that's a really, really attractive kind of risk-adjusted return for our investors.
And of course, too, with pools of assets like that, often the first 12 months is the most volatile things happen in those 12 months. So are you starting to see some arrears in those portfolios or you haven't seen any? What's your reporting like and can you share that with us?
Yeah, absolutely. So, I mean, generally speaking, the originators, the companies that we provide warehouses for, it's usually their second warehouse. So they've got a kind of established track record, so we can see the underlying asset quality, the performance in terms of arrears and losses coming through on their existing book, and we're part of that financing solution for typically their second warehouse. Although we have done some first warehouses where they've got a decent track record in any case. The data that we get is on a monthly basis, and we analyze that in terms of looking at arrears, losses, subordination levels, make sure they sticking by the portfolio parameters, etc. Um, there are obviously arrears in those portfolios. And one of the beautiful things about the warehouse type structure is we had one warehouse which we've exited, but back in the start of 2023, you remember there was the big expectation that the mortgage cliff was rolling off, where investors are rolling off the low fixed rates to the higher variable rates, and that was going to have a crunch on consumers' kind of credit performance and their ability to pay down not only mortgages but any other personal loans and asset loans, for example, auto loans. We were seeing that come through slightly in one of our warehouses. They just do a term out, so we actually managed to get them to inject additional equity into or junior notes to us in one of the facilities, that we were actually able to double the subordination level in that facility from 5 to 10%. And yeah, as it happened, that was probably being overcautious. But again, it's the type of example where you have those negotiations, to have those relationships with the originators, and you're able to negotiate those types of things on a bilateral basis to try and protect yourself. Now, subsequently, coming into 2024, we've actually seen arrears and losses actually perform better than we expected. And I think you've seen that kind of coming through largely in the bank's results as well, in terms of, not just the mortgages, but in terms of some of the personal loans as well, that they still have been incredibly well behaved. And the explanation that we believe was a reason for that was, when you had a fixed rate mortgage, you might have had a pile of cash elsewhere, and that would have made, so maybe you had a mortgage with CBA, but you maybe had the term deposit with Macquarie because there was no offset. So there's no benefit of having that with CBA. But once you rolled off that fixed rate into a variable, then you got that offset, and you're probably getting a better benefit from moving that excess cash that you had maybe with Macquarie back to CBA to be part of that offset. And what I think a lot of people, including the domestic major banks, hadn't calculated or hadn't appreciated was that volume of cash, excess cash outside what they could see in their system. So I think that's has helped protect and benefit consumers and their credit profile. And I think that's why you've seen arrears, and that's still the case including the more recent data, behaving better than we expected. And certainly kind of expect that to be maintained going forward. And hopefully that'll be the case, especially once the RBA starts cutting rates and kind of giving a bit more slack to consumers.
I guess too, people have, like, employment's good, people have picked up a second job if they've needed to. There's other sources of income that have helped them pay or cope with higher rates, which is really encouraging.
Yeah, absolutely. I mean, obviously the biggest single factor as to whether anybody is going to be able to pay their personal loan or mortgage is employment. And as you rightly point out, unemployment, not just in Australia, but globally, has been very low, and looks like, it may tick up marginally, but I think it's still going to be, probably lower than everybody expected a year, 18 months ago, certainly lower now than I thought it was going to be, looking back. And I think that is a key critical factor as to whether people will move into arrears, because you've had the big spike. You've had the big spike in rates. You've had the big pain coming through in terms of those mortgages and those loan rates that potentially adjust to the higher RBA cash rate. And I think now, consumers are accepting, are able to pay and manage their budgets, maybe not aren't comfortable, but they're managing to get through. And, with the RBA potentially looking to cut in 2025, again, that should hopefully give people a bit more breathing space to continue to be current on their loans.
Look, I want to come back to private credit because I think that's a really important discussion that we're having today. But just while we're talking about RBA and the RBA cash rate, have you got any thoughts on what a neutral rate is and sort of what your expectations are in the next 12 months?
In terms of a neutral rate, I don't think the RBA really knows what that is, so I won't speculate there. But in terms of cuts, I think as long and the key, again for the RBA, the key factor in cutting rates is inflation, and at the moment it seems to be reasonably well behaved. It seems to be trending downwards. Hopefully that continues, and if that does, then I can see the RBA cutting maybe the back end of the first quarter next year into the start of the second quarter next year. And we're probably looking at 2 or 3 cuts during 2025 if everything goes to plan. But as I say, there's a lot of moving parts, and probably the biggest one is what happens in the US with Trump, and does that stoke global inflation? Is it going to maybe lead to a more bigger downturn in those countries that he potentially tariffs, maybe with China, and then, what impact does that have on Australia in terms of, the natural resources that we're selling to China as well. So there's a lot of moving parts, but I think, if everything goes to plan, the RBA at the moment seems to be very reluctant to cut, but I think it will do, and we'll have the dates to feel comfortable that it can cut next year. But we've got to remember as well, the RBA didn't hike as much as the rest of the world. So, it can certainly start cutting later, and it also has to think about making sure that inflation is under control before it does so.
Thank you, Mark. Appreciate those comments. Just coming back to private credit. So obviously you're in quite a niche investment part of the private credit spectrum. How do you see other parts of that spectrum? Obviously you're not finding them attractive enough to invest in, but there would be different positives and negatives in different parts of it. Have you got any thoughts there?
Yeah, so everybody seems to be starting up a private credit fund, and that's, obviously offshore, the big players in the US private credit space, they've got and had a lot of inflows. They've got a lot of capital to put to work, and there is question marks over whether there's a bubble in sectors, and certain commentators and certain articles will certainly point to that. And even in our niche market, in the larger part of town, we do see a lot of competition, a lot of capital flowing in from offshore that maybe has to go to work. And so in our space, we typically play in that niche mezzanine sector of a niche market, which is the warehouses. And our ticket size in providing that mezzanine solution is probably anywhere from 30 to 80, maybe to 100 mil in terms of the capital that we put together in the mezzanine part of that structure. The big end of town, probably the offshore, they are usually 100 mil plus, so that's competitive in that space. And then it's also competitive in the smaller space as well, in the probably 1 to 2 to 5 million mezzanine solution spaces, where there's a lot of competitors competing for those types of assets. So we feel that we're kind of sat in the middle, and rather than actually getting squeezed, we actually feel we sit there comfortably. There's probably a handful of players that operate in that space. So we feel that there's maybe less competition in that space, so that we can get more attractive and better rates for our investors. In terms of the corporate loan, leverage loan space, those deals are broadly syndicated. They're competitive in terms of the pricing. They'll as they'll try and oversubscribe, try and squeeze the pricing. It's a very competitive process in some of those corporate leverage loan deals. And probably in the real estate field as well, it can be quite competitive in that space, depending on geographical location, and a lot of funds do target that real estate part of their the private credit sector. And I think that's because a lot of investors do feel comfortable with real estate as an investment opportunity. But again, from an Australian point of view, as we know, Liz, the typical Australian investors are so overweight equities, and within equities are overweight financials, and then also they're probably overweight real estate. And we feel that fixed income, or I've always felt that fixed income should be a diversified generally to those asset classes, and then also should be a diversified to those sectors within those asset classes that are overrepresented. And I think that, again, the warehouse sector allows people to have that more diversified opportunity set that still offers really good risk return dynamics, but it's not real estate. It's not targeting the financial sector. It adds value to most people's portfolios. I would say, especially within Australia.
I think certainly the term's really attractive from my point of view. A 1 year term it's short enough, but obviously you're being rewarded enough. You're not locking yourself into a loan or a group of loans where actually ultimately you don't know what the maturity date's going to be, and it can be extended, whereas you have a get out clause if you want to, after 12 months. I think that's attractive from my view. Just talking about some of the other parts of that private credit, and I know there's been a bit on the AFR about fees in that space. Do you want to talk about what you think investors should be looking for with investments, and maybe the fees that you think are appropriate, or the returns?
Yeah, look, the fee topic is really important for investors to understand and grasp. And I think there is a bit of opaqueness around some fee structures out there for some private credit funds. Like at Kapstream, we only charge a management fee, and that's typically around about 89 basis points on the private credit fund, which we feel is competitive. But some other funds will have performance fees on top of that, and it's important to understand what that performance fee is, and then what the actual outperformance is. Is it over the cash rate, or is it over the target rate of whether that's cash plus 5 or cash plus 6? And then also there is important that investors really understand, on private credit, it's very bespoke, and there can be upfront fees for, doing the transaction. There can be line fees, there can be commitment fees for credit funds, and sometimes those fees go to the management. Sometimes they go 50-50, or there's a different arrangement. From Kapstream's point of view, we've always felt that those fees should go to the investor, because we're only here because the investor has trusted us to manage their money appropriately. And as such, we feel that we wouldn't get those funds unless it's for the investor. So the investor is entitled to those fees. And that's why we pass all those line fees, undrawn line fees, commitment fees, and upfronts back into the fund in terms of kind of return to the investors. And it's just important, I think, investors fully understand the differences, and what they're actually paying for, because they may see, for example, a low management fee, but maybe there's other ways that the fund manager is getting paid.
I've certainly seen fees over 2% and approaching 3%, and you start taking 2 or 3% out of a 10% return, or it's looking not quite enough, in my opinion, to tempt me to invest in that sort of product with those risks. And Mark, look, as we're wrapping up today, is there anything else you wanted to talk about? I know you've talked about your business and what you invest in. Do you want to talk a little bit about one particular fund, or give us a bit more of a rundown on maybe the private credit fund?
Yeah, sure. I mean, to just give you a bit more of a background in terms of Kapstream, we manage around about 10 billion of assets, 5 billion in Australia and 5 billion out of our Newport Beach office over in California. There's 3 main funds. There's the flagship fund, which is targeting cash plus 2 to 3, and there's the plus fund, which is targeting cash plus 3 to 4. Both of those are daily liquid, and then there's the Kapstream Private Credit Fund, which is available to wholesale investors only, and that is targeting cash plus 6. And even though we've been investing in private credit assets for coming up to nearly 4 years, we launched that at the start of this year on the 1st of February, and it's performing incredibly well. Kind of that's doing cash plus 700 over at the moment, so close to over 11% in terms of absolute return. And we're focused on trying to ensure that the underlying performance is focused on capital preservation. And then the first two funds, it's more on the liquidity, and they generate the returns as a third outcome. We generally don't chase returns at the detriment to especially capital preservation on the first two funds. The Kapstream DNA is a very much sleep at night portfolio. We're not trying to shoot the lights out. We're just trying to keep them on. Is kind of one of our mantras. So, and that's kind of the DNA that we taken through into the private credit fund, acknowledging that there's obviously additional risks and there's more risk to that. But having said that, we feel that niche part of private credit is the most attractive. You've got hard subordination below you, you've got excess spread coming through, you've got a big portfolio of loans, 40 to 50,000, as we talked about before, protecting you from those idiosyncratic lightning strike risks that will happen. And because you've got that diversification, hopefully it won't impact you as much as it would do on some of the other more concentrated private credit portfolios out there in different sectors. So, we've got kind of three main different products for different types of investors, and we're looking forward to attractive 2025. We think the portfolio is positioned well, and with underlying cash rates where they are, kind of outright yields are still very, very attractive for investors.
Just quickly, is income monthly or quarterly?
So on all funds, income is monthly, and so any kind of coupon income gets paid out.
And the private credit fund, is there a minimum investment amount?
It's around about 100,000, but on bespoke basis, we can have a discussion on that as to whether investors would like to or could fund smaller amounts, with potentially building up to that over time.
Excellent. Well, Mark Bayley, thank you very much for joining us today. We've certainly learned a lot, and wishing you well for the new year and Christmas season, and we hope you'll join us again sometime.
Thanks, Liz, and same to you. Have a good Christmas and all the best for 2025.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au, and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran, and we'll see you next episode on Fixated, the Fixed Income Podcast.